Look, small cap are very interesting. The opportunities are many and varied, so we have the flexibility to invest in opportunities as we see them. That flexibility means we can invest in growth companies, cyclical companies, or what we call stable compounders. We simply look for the best risk-adjusted returns and put our capital there. And the growth side of the portfolio, what we're looking for is what we call structural growth stories. Now, a structural growth company is a company that has its own destiny in its own hands. It can grow independent of the cycle. So for that, we look for a company that has a large addressable market, it has enough runway for growth. These companies should have an identifiable competitive advantage. What is it that gives them the right to go away and grab that growth with both hands? And then they've got to have the right resources, the right management team, the right strategy to go out and deliver on that opportunity so that we can harness that for our investors. Good example of how we think today, there's a company in a very exciting area of the market. It's called NextDC. It's a data center operator. Cloud is a very important investment theme that will be dominating markets for the foreseeable future. I mean, this is a multi-year theme, decades. And so NextDC, it operates data centers here in Australia. It has a track record of developing and delivering those data centers, getting them full and generating high returns on capital when it does that. Now, the company is now investing in its second generation of data centers, having filled the first generation. And the market is waiting for the completion of a significant data center here in Sydney, S2 it's called. That data center costs $500 million, we estimate. Now, this is a company that can generate 15 to 20% returns on capital that it deploys in this sector. And the market's waiting for that development project to conclude. And we think when it does, you should look at the earnings capacity that becomes available in that asset, and it would, I think there's something like $75 million worth of EBITDA we reckon we can get out of that portfolio, which is a significant uplift, a more than 50% uplift in the earnings capacity of the business. So that's the kind of thing we look for. We look through to see what the potential is, and we value the companies on the basis of their potential, not what they're earning today.